Hello, welcome. I am so happy to see you here today, and I'm really glad that you're here. Today's class is all about helping you understand the mortgage programs that are available to home buyers, especially first-time home buyers, and how these programs can be used to strategically create affordability and help strengthen the offer that you make on a home. So for those of you who don't know me or are new to this series, I'm Rhonda Porter. I'm a licensed loan officer in Washington State. I've been helping people with their mortgage needs for over 25 years, and I'm really excited to share this information with you. So you don't need to, I'm going to move this chat over here. There we go. All right. Whoops, sorry, forgive me here. Let me get rid of that. Okay, so you don't need to memorize loan programs or become a mortgage expert. My goal is for you to walk away knowing that you likely have more options than you think, and how many loan choices affect your monthly payments and offer strength to your offer. Also, what questions you need to ask before you make an offer. So this class is educational, no pressure, no sales pitch, and ask questions as we go, or you can ask at the end as well. So when people hear mortgage programs, they often think that it's a one size fits all type of situation. In reality, mortgage programs are just different rule books. Each program has its own guidelines around how much money you need down, credit and debt flexibility, if there's mortgage insurance, how competitive the offer looks to a seller. There's no best loan, there's just the best loan that's for you and your situation and your goals. And so what I like to do is compare various programs for you to understand what your choices are and to be able to make an informed decision that's best for you and your family. Whoever you work with as your lender, they will help you decide what program is best for you. And hopefully they take time to do what I refer to as a discovery call. And this helps you understand your personal financial goals as well as the impact of each mortgage program and what choice might be right for you. In our previous workshops, we've reviewed the steps it takes to be ready to make an offer on a home, including being fully pre-underwritten, pre-approved. And now we are at this stage, which is reviewing the different products and what your options are, and including how to create affordability. So we're basically in the middle of this timeline, and we've kind of jumped around a little bit, but this is where we're at now. And in addition to different mortgage programs, there are various mortgage terms available. So the most popular is probably a 30-year fixed rate, and it offers predictable payments with the most affordability. Sometimes the shorter term rates, like the 15-year, may be lower, but it's not always the case. Typically they are. And sometimes adjustable rate mortgages offer a lower rates, and they are typically will have a payment amortized for 30 years as well. ARMs are fixed for a set period of time, such as a 5-year or a 7-year ARM, and then they will adjust after that for a specific amount as well, depending on where markets are. And they are a little bit more complicated. I tend to not recommend them for first-time home buyers unless they fully understand an ARM. And lately, honestly, the adjustable rate mortgage rates haven't been, they're not always as great as a 30-year or good enough to where it justifies uh, the risk of having an adjustable rate mortgage over a fully amortized mortgage like a 30-year. And there's also temporary rate buy downs, which I'll touch on a little bit further on in this workshop. So just as an example, these are an average rates posted by Optimal Blue based off of rates from January 20th yesterday. And so they were quoting for a 30-year fixed conforming 6.097% and for a 15-year 5.386%. So that's a nice difference there. And a lot of people do want that 15-year rate, but they want that 30-year payment. So with the 30-year, if we have a loan amount of 500,000 and a rate of 6.097, your principal and interest payment would come out to 3,029. With a 15-year at 5.386, that payment comes out to 4,055. These payments don't include taxes and insurance. but you can see that that 15-year payment is about $1,000 higher than the 30-year. You can effectively have a 15-year payment by having a 30-year if you wanted to take that mortgage and plunk down an additional $1,000 for your principal every month. But most people kind of need that extra cash flow in their livelihoods. And so what I encourage people to do typically for most people is to opt for the 30-year and pay off any high interest rate debts that they may have instead, and make sure that they have their retirement funded before they pay off their mortgage or apply more towards their principal. And there's 20-year mortgages as well too, which is kind of like in between both of these, kind of a happy medium. So, but there are different options available to consider. And you've probably heard about lately the 50-year mortgage that's been suggested by our administration. Um, that would probably have even a higher rate than a 30-year if that mortgage ever comes together. So something to think about is like there are different amortizations that go with each of these mortgage programs that we're going to be discussing today. So let's get into the mortgage programs. With a conventional mortgage loan, they are very common, especially for first-time home buyers with stable income and decent credit. A conventional loan would be a mortgage that is using the Fannie Mae or Freddie Mac as the actual lenders or underwriting guidelines. And you may have heard that you need 20% down to have a conventional loan, and that's an absolute myth. Buyers can go with as little as 3% down if they're a first-time home buyer. And there's programs where that will have like improved rates and even improved mortgage insurance that you may qualify for. With less than 20% down, you're going to probably have mortgage insurance. And the important thing to know about with conventional loans is that PMI or mortgage insurance is not permanent. It can be removed if it's in your monthly payment. But your payment will adjust with that after your loan to value reaches 78% of the original amount. So sellers tend to like conventional loans because they are seen as predictable and straightforward, and they just tend to be preferred over other types of financing. There are conforming loan limits that vary by state, and they come out every year, typically in November, end of November. And for the 2026, the loan limit for a single family home is $832,750. Some counties are considered high cost. And so in King, Pierce, and Snohomish counties, our conforming loan limit for a single family home in 2026 is 1,000, excuse me, I need to back up on that, $1,063,750. So if you go $1 over any of these amounts, that could put you into a jumbo category, which tends to have a little bit more strict guidelines and underwriting requirements. Now, the program that I mentioned just a few slides ago for first-time home buyers are 3% down would be the Home Possible and Home Affordable programs. And this is through Fannie Mae, and they have, Home Ready and Home Possible. They allow for reduced interest rates or better pricing with the interest rate and better pricing with the mortgage insurance than if you don't qualify for this. And in order to qualify, you need to meet certain income limits. And so currently for King County, you would have to have a income limit, or at least for the Federal Way area, have your income at 117,200 or lower for your annual income. So, and there may be other incentives that are available as well, or different grants that can be coupled with this too. So there's also with this program, if there are areas that are designated as needed revitalization, then people that are above those income limits may be able to use this program too. So we just have to check each home by address and look at everybody's income and application to see what kind of programs you may qualify for. So FHA loans were designed to help homeownership more accessible. They allow for lower credit scores and higher debt ratios. And so this can be helpful if you're just getting started building your credit, and just don't qualify for a conventional mortgage. So the trade-off with an FHA mortgage is that the mortgage insurance is both upfront, which is financed into the loan, and monthly. And oftentimes with FHA, the insurance will stay on for the life of the loan. And so some people will opt to try to refinance out of it. So the interest rates on FHA tend to be really competitive though as well. So and there's no income limits with FHA, and also each county has their own loan limit specific. So it's not like the conventional where it's the same throughout, and there's just a few counties that have an exception. And I have a complete list of loan limits on my blog at the Mortgage Porter for FHA loan limits in Washington State for 2026. So FHA can be a great stepping stone. And as I mentioned, sometimes buyers can refinance into a conventional loan later. It also allows for manual underwriting, and they can make more exceptions than a conventional mortgage can. Another kind of cool thing about an FHA mortgage is that they can also be assumable. So this is a feature that other conventional mortgages don't have. So back in the day when rates were, around 3%, an assumable FHA mortgage would be a desirable thing for a seller to have if they were selling their home. I hope I'm not talking too fast. I'm trying to be slow. So VA loans are a great program, and if you are a veteran or active duty service member, VA loans are one of the strongest programs available. They allow for zero down, no monthly mortgage insurance, and they have very competitive rates. And there are no loan limits for VA loans. So you can literally buy a home if you're a veteran, 2 million, and have a $2 million loan amount. VA loans have a bad reputation from the past. And I think it's getting better, but some sellers, if and listing agents, if they're not aware that VA loans are much better than what they used to be. Sometimes people have an issue with the appraisals from the past, and also that the seller had to pay or often paid for a lot of the closing cost with the VA loans, and this is just simply not the case anymore. They are an excellent loan, and I will compare scenarios for veterans that I work with of a conventional financing to a VA loan. And oftentimes, when you look at them side by side, the VA loan is better. But it is that choice for the veteran to make. And despite the myths about VA loans, they're actually very strong, and especially if they've been paired with a solid pre-approval. USDA loans are for homes located in rural areas, and they have a zero down payment required, just like a VA loan. But the thing with a USDA loan is that income limits apply, and it is for the whole household, not just for people from the loan application. So, if you have your parents living with you, or if you have a child that has a part-time job, like a senior in high school, all that income has to be calculated. Underwriting is similar to FHA, so it is more flexible. So, but with USDA, the individual property address has to be ran, and you can literally have a house on one side of the street that is eligible, and across the street, the home may not be eligible for a USDA loan. So, homes located on the light orange areas on this map are not eligible for USDA financing. So we touched on private mortgage insurance a bit and on previous workshops, but I think it's good to review it since we're going over affordability. But mortgage insurance, also called PMI, for private mortgage insurance, is involved with various mortgage programs when you have less than 20% down. With a conventional mortgage, the amount will vary and it's risk-based. It can be monthly or a one-time premium. And if it's monthly, as I mentioned earlier, it will drop off eventually with your payment automatically. Government-backed loans like FHA, VA, and USDA technically don't have PMI because it's not private, like private mortgage insurance, but they do have their own form of insurance. And so FHA has the upfront funding fee that is finance into loan and monthly mortgage insurance. VA has an upfront funding fee that will vary depending on the eligibility. And USDA has an upfront and monthly guarantee fee for the life of the loan. Down payment assistance programs help buyers bridge the gap between savings and what's needed to buy. These can come in the form of grants, forgivable loans, or deferred loans. They can reduce the cash needed up front, but they can affect your monthly payment and how sellers often view the loans. So you need to use them strategically. This is where working closely with your lender and agent really matters. So if you did have, a seller and they're looking at two offers, and one is a 5% down conventional and one is using down payment assistance, they might view the one with down payment assistance as weaker if they're the same sales price. So it's a decision that the seller and the listing agent need to make, and something that you need to consider when you're getting ready to present an offer on a home. So the Washington State Housing Finance Commission program offers several down payment assistance options. And this is a class I used to teach, and I can help you with this type of loan. The most popular is probably the Home Advantage program, and you do have to use their first mortgage. You can get assistance in the amount of 3, 4, 5% of the first mortgage loan amount and at 0% interest. And it does have an income limit, as you can see here, of 215,000. And it's a great program. The sometimes the rates can be a little bit higher, but if we just the price out based on that day and compare to other programs. We offer a down payment assistance program as well, a couple different ones too at New American. So it's just good to consider everything and see what is going to work best for your scenario. A new program that Washington State Housing Finance Commission has come out with offers up to $150,000 in assistance, and this is their Covenant Homeownership Program, and it was just recently created just a couple of years ago. And there are income limits based on the county, and you need to be able to document that your parent or grandparent experienced housing discrimination before 1968 in Washington State. And it's also limited to a specific group of people. Namely people who are Black, Hispanic, Native American, Alaska Native, Native Hawaiian, Pacific Islander, Korean, or Asian Indian. So there's a little more work to do for the documentation involved with this loan, but if it's something that you're eligible for and you'd like to have the down payment assistance, this is definitely worth investigating. So we also have several specialty programs and just all of these I could talk quite a bit about, but I just want to put this on your radar. And if it's something that you're interested in, this is definitely something that we can talk about more. We have the renovation mortgages, both conventional and FHA. They allow you to buy a fixer-upper, something that needs a little TLC, and finance improvements with minimum down payment. And the amount that you can finance is based off the after improved value, so of what you're going to do to the home. So this can be great if you're finding something that maybe it's been overlooked on the market and you can wind up fixing it up to be your dream home. Reverse mortgages are wonderful for seniors who are 62 years or better, and it allows you to purchase a home. You do need a down payment, and with a reverse mortgage, it's more than a regular standard mortgage. But after that, you don't have a mortgage payment. So that can really help with plans for retirement when you are in your golden years. With the reverse mortgage, you still have property taxes and homeowners insurance due. The doctor's program is a newer program for us, and it is a zero down payment with no mortgage insurance. We go up to $2 million on that. And it's a pretty neat program. You do have to be, it is only available for certain mortgage professionals. Oh, and I should mention there's no mortgage insurance on that. And last but not least, we also have a cash buyer program. And so this allows you to compete with cash buyers, and then you wind up buying the home back from the cash buyer program. And this is available for first-time home buyers. So you don't need to have a home to sell in order to use this. And your financing for this program, your permanent financing that you'd be buying the program back from would be conventional or VA. And this is another program that's really unique. This is called Dream Builder, and it's for people who just don't quite qualify yet. This is a program where the house that you want to buy is bought for you through an FHA eligible government entity. And you're able to live in the home and essentially build equity with the goal of buying the home back from the entity. So this is another program that warrants its own class, but it's just something I want you to be aware of in case you or someone you know have been turned down for a mortgage to buy a home. This could give you an opportunity to secure it and share in the equity. So affordability is, it's not just about interest rate, it's about the full monthly picture, the mortgage payment, taxes, insurance, homeowners insurance, the homeowners association if there's one, utilities, and it's your comfort level. So sometimes we can create affordability by choosing a different loan program, using seller credits, temporarily buying down the interest rate, or it might be that instead of like putting more money down, we're paying off and restructuring certain debts. So my goal is to not just to qualify you for the maximum that you qualify for, but also to help for you to buy comfortably. So it's really important to be able to determine what you want your monthly mortgage payment to be. So sellers can contribute towards your allowable closing costs when it's negotiated in the purchase and sales agreement. So they cannot contribute towards your down payment. So the allowed amount depends on how much down payment you're going to do, and or also referred to as your loan to value or LTV, and the program type. So in a hot market, it might be challenging to have the seller contribute towards closing cost if there are other offers that will net the seller more, they're not having to contribute. So, and this is where we might have to get a little creative. But you can see on this chart, like if you're doing 3% down, you could ask for 3% of the sales price as a credit from the seller. So it's very important to communicate with your loan officer and with your agent and to help put together a plan before you make an offer. So the seller can also contribute towards the interest rate buy downs to reduce your payment. And so part of like what I talked about is how much they can contribute. Again, it's going to depend on what your down payment is. And so with the rate buy downs, a permanent rate buy down is when we use the funds to buy down your rate to the note rate. And it's going to be what your payment is based on for the term of your mortgage. And so, so there are different points. We've talked about this in previous classes. If you got a lump sum from the seller, you can have that just go towards closing cost, or you can buy your rate down. With a temporary rate buy down, that is the seller subsidizing your payment temporarily. So your payment will eventually adjust to the note rate. So for example, with a 2-1 buy down, if the rate was 6% for your note rate, and I'm just using this as an example, the first year, your payment would be based off of the 4% interest rate payment. And the second year, after 12 payments of the 4%, your rate would be based on a 5% interest rate payment. And the third year in term, your rate would adjust to the 6% note rate. And the cost of the buy down is basically the difference between that payment, the 4% and the note rate, and the 5% and the note rate added together. And that's what the seller has to pay in order to subsidize and bring your payment down. So it's a great program if you think that you're going to refinance within that time. Or otherwise you need to be prepared for having the 6% or whatever that note rate payment is. So yeah, your mortgage choice does impact the strength of your offer. And so a lot is going to depend on like what is going on in the market when you're getting ready to present an offer. And when sellers review offers, they're asking two questions, but one we're going to talk about now is which offer is likely to close smoothly. And so that's why it matters to not just be pre-qualified and to have a full pre-approval. Your lender is playing a behind-the-scenes role in strengthening your offer by communicating clearly with the listing agent. I often reach out to them when an offer has been presented just to confirm that you have gone through full underwriting and that you are completely pre-approved, and to let them know that we will be supporting their timelines for the transaction. It's also important to make sure that the loan structure matches the offer terms. So it's important that we are in communication with your real estate agent so that if they are asking for, cost, or not asking for cost, but you wanted cost, you can see that it's important that we're all on the same page. And two buyers with offering the same price, the one with the stronger financing offer is going to be the one that's probably going to win the offer or win the home. So the seller is also trying to select, with the assistance of their listing agent, which buyer will allow them the most cash back at closing too. And so again, the stronger your offer, the better your odds are. And a lot is going to depend on the market, and your agent can help guide you on if it is a buyer's market or a seller's market and how strong your offer needs to be. So with these scenarios, which offer would you select? I mean, if someone is just pre-qualified or if they're making a low offer, asking for a lot of sellers credits or a long closing, or maybe they're FHA or VA, they might be less likely to have their offer accepted if they were fully pre-approved, making a full price offer. They could maybe ask for seller credits or not. Maybe they're offering a quick closing. That's something a seller often likes. And conventional financing or cash buyer financing. I should have added that on that. So that's something else that sellers really like, is a cash buyer too. So let's crunch some numbers. So this is a cute Rambler that just sold. We'll be closing soon in Puyallup, and I helped create a financing flyer for it with these programs back in mid-December. And these programs are all kind of geared towards first-time home buyers. And so on the first column here, we have a 3% down conventional program. The home is listed for $49,950. And so the loan amount would be 475, 252 with 3% down. The rate was 6 1/8 for the note rate and 30-year fix. And with the property taxes, insurance, and home and mortgage insurance, the payment's estimated at $3,514, and they would need about $29,000 for total funds for closing, including the down payment and the closing cost. If we did the Home Advantage down payment assistance program with this, the loan amount would be $494,262. It says blended rate of 5.889. The actual note rate on this was 6 1/8 as well. But we have a down payment assistance with a rate of 0%. And so we blend those rates, or they get blended together, and it comes up with the rate of 5.889. Total payment of $3,598.59. So not much more than the scenario, but you're only having to bring in $10,566 roughly for your total funds for closing. With the VA loan, we're doing 0 down, rate of 6%, so you can see it's better than a conventional rate, and the payment of $3,631.97. So it's slightly higher because our loan amount's higher. We're financing and a funding fee there, but the cash to close is $14,631. The last is just an example of a 20% down scenario. If somebody had that and wanted to go that route, and their payment would be $2,849, and they would need $111,500 roughly for their total funds for closing. So if we're going to look at some different strategies in presenting an offer, I'm just using what we had from the first column with the 3% down conventional scenario on this. And I like to do this with all my clients so that we can make sure that we're on the same page, reviewing different mortgage programs and then also different ways of structuring the programs as well. And so on the first column, we have the full price offer with 3% down, same as what I showed you on the last screen here. And let's say that a buyer decided, well, they'd like to offer $15,000 less to save money. That would bring their payment to $3,420.84. So they would save $94 a month on their payment, which is great. Their cash to close would only go down by about like $608, so not very much. So they do get some payment in the savings, but not much in the cash to close. They could instead do a full price offer, and instead of dropping the price, ask for about $15,000, which is the 3% limit is $14,600. And they can just apply that to their closing costs. So, and you would do this like if they were okay with the payment for their short funds for closing. So they'd have the payment of $3,514. They would apply that 3% towards closing costs, and they would bring in $14,773. Another possible solution or thing to consider, but I like to show clients, is let's say the seller, but this house is new on the market, and the seller doesn't want to drop their payment by $15,000, or they don't want to just give the seller or buyer $15,000 from their proceeds. They're not ready to do that yet. You could possibly ask them to offer above the list price, like $5,000, and then ask for the 3%, like roughly $15,000. So that way they're not losing as much, and it's a bit of a compromise. So with this scenario, we're offering $494 for the same home. We're buying the rate down to 5.875. The payment is $3,462, so it's still lower than this amount, and the funds for closing is $19,237. So it's just a compromise, and it might just be like a different scenario or a way to get a seller to possibly accept your offer and be a win-win for everybody. So in my previous workshops, we've talked about the importance of having a buyer's agent represent you and not working directly with the listing agent. It's also very important that your lender and real estate agent work together, especially if we're creating a plan and we're asking the seller to contribute towards your cost or buy your rate down. This needs to be done when your agent is preparing your purchase and sales agreement and before the offer is presented to the seller. Because after it's presented, you can't say, oops, we forgot to ask for this, to the seller, because they're probably going to say, tough luck, we have this signed offer here and we're going to adhere to it. So again, really important that we're all on the same page and have a communication before your offer is accepted or presented. And so this is where everything gets to be kind of fun and exciting, is getting ready to shop for the home. And the biggest takeaway today is that mortgage programs are the tools that, when used correctly, can really help you buy with confidence. And the more you know, the better. And you're taking all the right steps by watching this class and participating here. You don't need to figure this out alone. So education plus the right team can make such a huge difference. So our next class is going to be covering from your offer being accepted all the way through closing day. I don't have that class scheduled yet. It'll be in the next couple of weeks, and I will be posting on my blog once that class is up and ready to be signed up for. So for your optional homework, I would like you to try to determine what you would like your total monthly mortgage payment to be, how much funds you think you'll have for closing, and what your credit is. You could just say like if you think it's excellent, average, or needs work, and determine what type of mortgage program you think you would qualify for. You can send me an email and let me know which one you think it is. And if you need some help, I'll help you with your homework on this. There's no right or wrong answer, and there might be multiple mortgage programs that might work for you, but just put some thought into it and let me know what you think. And a big congrats to you for taking another step towards homeownership. And in this class, we've reviewed different mortgage programs and some special products, as well as buy down strategies to help create affordability with reducing funds for closing and lowering your mortgage payment by using seller credits. You will be receiving a link to the workshop dashboard, and it'll be updated with the most recent class. And remember, each module does contain the class from the previous recordings. And if your real estate agent referred you to this class, please let me know so that I can thank them. And you don't have to wait for our next workshop. If you want to learn more about the home buying process, or if you have questions, you can scan the QR code or reach out to me via my contact information here to schedule an appointment. I'm always happy to help you or anyone that you know with a mortgage need or your home buyer's needs. I hope you have a great rest of the week, and I look forward to talking with you soon. And again, our upcoming workshops are going to be from offer accepted to closing day, what happens after closing, and what is a refinance. So take care and have a good day. Bye-bye.